will speak on TDS and related issues in May, and CS Sanket Desai will address us on GST refund in July. I wish them best of luck. Will speak on TDS and your love and participation are motivating us to do more and more. Our core strength is physical meeting followed by working meal, which all of us are missing. In view of the continuing COVID-19 pandemic, our meeting will be held through Zoom platform till further notice. Friends, our colorful, attractive, and informative invite of webinar is a brainchild of our Deputy Convener, CA Parag Jhaveri. Thank you, Parag. This is your study circle. We welcome your constructive suggestions. The Ministry of Corporate Affairs, Government of India issued notification dated 24th March 2021 to amend Schedule 3 of the Companies Act 2013 to enhance the disclosure requirement to be made by the company in its financial statement. By these amendments, MCA increasingly stringently in compliance and adding numerous additional disclosure in a financial statement. The main purpose behind these amendments is more transparency. These amendments will come into force with effect from first day of April 2021. Schedule 3 is divided into three parts: Division 1, Division 2, and Division 3. Majorities of amendment have been undertaken in response to amendment covered in the newly issued Companies Auditor and Report Order, that is called CARO 2020, and the Company's Indian Accounting Standards Amendment Rules 2020. There are also changes in general instructions for preparation of balance sheet and profit and loss account. My friend and well-wisher, Edwin and Sham Sundar will elaborate these amendments during their speech. We have kept two sessions each of 3 hours for these topics on today and on this Friday. All questions will be taken at the end of the meeting subject to permission of time. Please type your question in question answer box provided below. They will be compiled by CA Jigar Modi. I request CA Parag Jhaveri to introduce Edwin, and later on CA Rasna Jain will introduce Sham Sundar. And at the end, vote of thanks will be proposed by CM Manish Trivedi. Happy learning, friends.
Thank you.
Over to you, Parag.
Thank you, Dilip bhai. It's a pleasure to introduce the speaker for today. CA Edwin Paul Augustine is a senior partner for audit and assurance of Mr. Sharp and Tandon. Presently, he is a technical reviewer appointed by Quality Review Board and Tax Audit Quality Review Board. He is a designated audit quality control inspector by Russell Bedford International, headquartered at UK, the overseas network. The firm is a member. He has experience in various sectors like manufacturing, construction, infotech, technology, consumer business, power, finance, etc. He has varied experience of overseas assignments. He has undertaken assignments on behalf of the group in Nigeria for one of the largest business houses, having interest in various sectors like hospitality, cement, logistics, sugar, infrastructure, fertilizers, and refinery. His exposure in business valuation, valuation of goodwill, due diligence assignments, and risk-based internal audit and ICFR audits. His experience in audit and assurance services domain, covering audits of listed companies, tax audits, attest functions, management audits, statutory compliance audit, and VAT audit. He has been a speaker in various study circles and in-house. Besides his professional career, he is actively involved in philanthropic service through large charitable trusts that serve the poor and marginalized youth. He has involved in many outreach programs during the pandemic, rendering assistance to migrants and the marginalized. With this, I request Sir to share the knowledge with us.
Okay. Over
Thank
to
you.
you, Edwin.
Thank you. Thank you, sir, for a very generous introduction. I would also like Shyam Sundar to be introduced. I think if Rasna Jain can.
Okay, now, okay. Rasna, introduce Shyam Sundar now.
Yeah. Thank you, Dilip sir.
We
Thank you,
thought
Parag
that
sir.
we'll introduce him when he will speak, but if we,
Achha.
okay. Yeah, okay. Please introduce, as Edwin said.
So, good evening, everyone. It's a great pleasure for me to introduce CA Shyam Sundar sir. So he is a Bachelor of Commerce and he joined the firm Sharp and Tanan in the year of 1979. And he also assists Mr. Edwin in the technical, who is a technical reviewer appointed by the Quality Review Board. And he is experienced in various fields like manufacturing, construction, consumer business, finance, etc. And he's also he is going to tell us about the amendment that has happened in the Schedule 3 of the Companies Act 2013. So, Mr. Shyam Sundar, over to you. And
Okay, thank you, Edwin. Thank you, Shyam Sundar.
Thank you. I also have my young colleague who's there with us, Preeti Pujari, and I'd like her to introduce herself for the benefit of all. Okay, Preeti.
Preeti, unmute yourself.
Yeah. Hello, everyone. I am
Hello.
Preeti Pujari, and I'm a second-year article in Sharp and Tanan. I signed up for my articleship after passing my inter examination during my graduation. I'm also an NMite, and currently I'm pursuing my TY BCom along with the CA course. I'm due for appearing for my finals in May 22. Pursuing my internship in Sharp and Tanan has been a journey with continuous value addition and knowledge enhancement. I have varied experience by assisting in many statutory and tax audits and got the unique privilege and opportunity to team up with Edwin sir for compilation of the presentation which was presented last year in Churchgate CP Study Circle. I would also like to thank each and everyone participating in this virtual session for accepting me as a part of this session. And special thanks to Edwin sir who gave me this opportunity once again to collaborate for this presentation. This shall be an important part of my CV and I will be always grateful for this. So thank you, everyone.
Okay, all the best, Preeti.
Thank you.
Over to you, Edwin and Shyam Sundar. Edwin, we can't hear you.
Yeah. Okay. Can you hear me now?
Yes, we can hear.
Yeah, because there's some sound coming in the background. I don't know. Thank you, sir, for the very generous introduction of my team. And I take this opportunity to thank the Churchgate CP Study Circle for giving us this opportunity to make a presentation. It is a real privilege and we are very thankful. The first presentation which I had made was in St. Xavier's College, and there we had interacted with a gem of a person called Mr. Clyde,
Yes,
whom I remember today. It was on the 29th of May, I think he expired. And Clyde has always been there in my mind,
Right.
and he is always there whenever I pray for the dead. He is one of the person to whom I pray for.
Yes, we all miss him. We'll miss him.
Yes. And I also take this opportunity to compliment Manish Tiwari for the very nice invite, as Dilip sir so
Yes.
correctly mentioned. It was very catchy. And when I shared it with my partners, they were also pretty impressed. And many of them are posting that on their LinkedIn. So you may be able to see that. So thank you, Manish. And it was a very, very innovative piece of art that you have done. Yeah. As Dilip sir very correctly introduced, the MCA had amended Schedule 3 of the Companies Act 2013 on 24th March 2021 via a notification. And there was a wide implication of that particular amendment which has come through. And after the notification came, I had the occasion of speaking to many senior colleagues within my firm, outside, my peer group. And what disturbed me was many of them were wondering why all these amendments have to come. Aren't we already burdened with so many amendments. What is the purpose? And then I just started thinking. I said, yes, there must be some thought process. Well, one thing from my experience, I realized government doesn't do anything randomly. Whatever the regulatory does, it would be an follow out of what has happened in other geographies. And all of us are well aware that India is gradually going to converge to a full-fledged IFRS presentation. Presently, we are having both the frameworks which are concurrently running. We have the IGAP and we have the Ind AS which has come in. If you have observed, the IGAP amendments are gradually taking it towards the Ind AS background, with so many amendments coming in. One of the examples being Ind AS 10. Ind AS 10 has brought in so many amendments which are very close to the Ind AS 1, which is there. So there is a purpose, and I thought, let me just investigate and find out what was the thought process for the world to converge towards such comprehensive disclosure requirement. What necessitated that? Why should a 10 or 12 page financial statement today is becoming larger in size, is becoming so full of information that many times we are lost in the maze of information that is given in the financial statement. And my research took me back, and I stumbled upon what happened to the Lehman Brothers in 2008. Everybody is well aware of what happened to the Lehman Brothers. If you can just I'll just tell Preeti to just put that slide on Lehman Brothers. Lehman Brothers impacted the whole world after its collapse. And very, very paradoxically, in 2007, Lehman Brothers was awarded as one of the best uh, investing banker. And just 1 year later on, Lehman Brothers collapsed. And the whole world was grappling. What happened to Lehman Brothers? Why did it collapse? It was number one most admired security firm in 2007. That's what for the Fortune 500 magazine mentioned. And 2008, it fell like a pack of cards. And the analysis of Lehman Brothers indicated that it started from a very humble beginning. It started as a dry goods store, but eventually branched off into commodity trading, broking. The firm survived many challenges, but eventually was bought down. What caused the collapse? There were many reasons, and one of them was that the world was not able to analyze the information given in the financial statement. They thought that the financial statement was inadequate. It had to reveal more and more information which the investor wanted, which the regulator was supposed to be monitoring and evaluating, and helping that particular organization to do course corrections the way SEBI does in India, where the way MCA does in India. And the world felt no, the financial statement was inadequate and it had to be made more and more comprehensive. And it was at that point in time that the IFRS group also took its shape. The first IFRS statement was made on 1st January 2004. And they said the IFRS would be an answer to what was the drawback which made Lehman Brothers collapse, which impacted the world. And till today, many of them are saying that the world has not fully got over that impact. So much of resource was wasted, so much of regulatory time was wasted in trying to find out what exactly happened. As the screen says, the collapse of Lehman Brothers on September 2008 triggered a global financial crisis that saw virtual meltdown of the financial market. 10 years down the line, the world still shudders to think about the nightmare that the collapse would unleash across the global market. So everybody started pointing fingers. No, we need a financial statement which is going to be robust, which is going to be comprehensive, which is going to bring uniformity in comparison, and which will be giving the financial results more as a substance than rather a form. Yeah. I also just had a look at what was the advantage that one had by adopting IFRS. What IFRS was the answer to everything? Just put that there. So just to very quickly recap, what was the advantage of going into an IFRS type of a presentation? Yeah. The advantage of an IFRS prepared financial statement, there was more focus on the investor. The investor, rightly so, said, we are putting in our money, we are putting in our capital. The creditor said, we are partnering the organization, we are initially financing the organization by giving credit. We must know the health of the organization to whom we are supporting. So we need a financial statement that will help give me a health check. So IFRS started focusing on the investor's needs. Loss recognition was taking place in a timely manner. Comparability was more possible, was much better than what was in the other type of financial statement prepared under the national GAAP. There was standardization of accounting and financial reporting. There was improvement and consistency, transparency of financial reporting. Now, with this background, we need to see what the MCA amendments to Division 1, Division 2, and Division 3 has got. As part of this research, we made a study. What is the information that a typical annual report discloses? The content of a typical annual report in India of a listed company listed on the stock exchange, besides the notice for the AGM, gives highlights, financial highlights. Many of them give a highlight from 5 to 10 years. They show the growth strategy, corporate social responsibility, companies' approach to ESG, environment, social governance, corporate governance, board of directors composition, board evaluation, risk management, code of conduct, management analysis and discussion, economic growth, key growth drivers, company overview, data about the company, manufacturing location, business segment, new product, SWOT analysis, management outlook from where the revenues are coming, other income, material, and a host, right from annual report, which otherwise those of us who have done audit in the old regime would have found how difficult it was to get all these information from the company management. Many times we had to go to the ROC, pay fees, and extract this information of the company so that we get a better background. But today, all this information is available in the annual report, and yet the feeling is it is not sufficient. Even the regulators are feeling that no, the annual report should give more information, which will enable us to regulate the industry in a better and more effective manner. All this information having come into the annual report of a company, that there was another set of problems. The information given by the management, is it in sync with the information audited by the, attested by the auditor in the financial statement? The institute came up with SA 720, auditor's responsibility relating to other information. So information had to be synchronized because it was causing more confusion. So although on one hand, there was a demand. More and more information should be given in the financial statement. There was also a necessity that they make sense. There is uniformity. There is no variation. The dividend figure disclosed in the financial statement should not be at variance with the dividend figure disclosed in the director's report. R&D expenditure shown in the financial statement should be in sync with the R&D expenditure in the director's report. And many times there were variations, and that confused the shareholders, that confused the investors, that confused the stakeholders. Which information is correct? Which information should be taken as authentic, appropriate, correct, and complete? Because in the absence of that, it would be impacting the decision-making process. So with this background, I thought we should be able to appreciate what this present amendments have done. We have also done another research by the team. What is the size of the annual report which is available today? So we did a research on the first 20 companies. ACC, the number of pages in their annual report, 374. The largest being Larsen & Toubro, 612. Tata Steel, 449. Grasim Industries was again around 400. So much of information, so much of expenditure is being incurred by various companies to educate the shareholders, because there is a need and there is a requirement. So wealth of information is available, yet at the end of the day, when some crisis like what the Lehman Brothers takes place, then everybody questions, is the information sufficient or we require something more? So as Preeti mentioned very correctly in this slide, constant thirst for information. So keeping this background in mind, I think MCA also thought that yes, it has to fall in line with the world practice, that all the geographies in the world, they are upgrading, they are enhancing the information, and they are making many of these information now to be bought within the annual report, to be subjected to an audit, so that those information will have authenticity. The regulator will be able to have reliance on that and will be able to monitor how the company is functioning. Today's presentation, we have divided into 3 parts. Division 1, which primarily is what we are going to cover today. Division 2 and Division 3 we'll be covering in our next session. As Dilip sir very correctly mentioned, Division 1 generally is covering the financial statement for a company whose financial statements are required to comply with the company's accounting standard rules 2006, what we in the old school know the IGAAP way of preparing a financial statement. So our presentation today will have 3 principal disclosures. There will be a disclosure section, there will be a presentation section, and there will be other requirement section. What we'll be covering today will be promoters shareholding, trade payable aging, trade receivable aging, CWIP, and intangible assets under development, aging of thereof, property, plant, and equipment related disclosure, disclosure relating to revaluation of PPE, loans and advances to promoters, key managerial persons, and other related parties, and financial ratios. So primarily we will cover this, and let's see how much of disclosure justice we will be able to do, considering the time that we have in hand. The first disclosure that will be required to be made by the company under the share capital, besides the other disclosures that are already there, will be disclosure relating to promoter shareholding. Now, this particular disclosure in the past, this was being covered when a company was subject to due diligence. All those of us who are involved in due diligence, one of the areas which we covered was to find out what is the promoter's shareholding. And today, the regulators have felt, yes, it's a key information and therefore should be given in the normal disclosure requirement rather than somebody needs to go and do a due diligence. So now this is going to become part of a regular disclosure of the financial statement. So the investor, the suppliers and the other stakeholders who want to interact, there will be no more requirement to do a deep diving to find out who's managing, who is running the affairs as a promoter. It will be available in the financial statement. So the requirement given is the note on the share capital in the financial statement shall mention details of the shareholding of a promoter along with changes in even if such shareholding is less than 5%. So they have given the framework disclosure format. There will be a promoter's name, number of shares, and percentage of shares. It will be interesting to note what is the Companies Act definition of a promoter. Who is a promoter? As per section 269 of the Companies Act 2013, a promoter means a person who has been named as such in the prospectus or identified by the company in the annual return referred to in section 92. So it's a very key information. And as I mentioned in the past, we used to go to the ROC's office to pull out the prospectus to find out who's the promoter. Today it is given. A promoter also is a person who has control over the affairs of the company directly or indirectly. Whether a shareholder, director or otherwise, in accordance with whose advice, direction or instruction the board of directors of a company is accustomed to act, provided that nothing in the subclause C shall apply to a person who is acting merely in a professional capacity. So if you have a professional who is directing the company, who's controlling the board, but is not the one who has interest to control the company in the manner specified under 269, then he cannot be considered to be a promoter, though he controls the affairs, because he is controlling on behalf of the real owner. So he doesn't meet that definition of a promoter. So this disclosure is a key disclosure and a new one which has been added. Right. Trade payable. This is also a first time disclosure. It's on the similar lines that trade receivables are being disclosed. With respect to trade payable, the aging schedule in respect to trade payable shall be provided for. If no new due dates for payment is specified, the date of the transaction shall be considered for this purpose. Unbilled dues accrued or provided shall be disclosed separately by the company. Implication on for the assessment for limitation under the Limitation Act 1963 for such proceeding under the IPC. So what is the disclosure required to be given? The disclosure required to be given is the trade payable will get disclosed in two broad category: payment to MSME and payment to others. Again, in case of MSME, there will be categorization. Is the payment to dues to MSME disputed or not disputed? Others, is it disputed or not others? And the aging would be less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. A lot of implication in this disclosure, though it looks very simple, but there's a lot of implication. Generally, as I mentioned, that this particular disclosure, one would be gathering primarily as part of the audit evidence file. What the audit effort would be, why is payments not made to a supplier for more than 2 years and above? Are those credits genuine? Which supplier would be waiting for payments to come, provided it is not disputed? And generally, when a bill is accounted in the books of account, every effort is made by the management that undisputed bills will be booked only after it is resolved. So a very important audit aspect, the audit team doing the audit of trade payable will have to exercise more due diligence and care to ensure that the categorization, the buckets, less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, they are able to be extracted from the accounting software. So most of the accounting software will be required to be customized. Large companies already have that. I do not know whether under Tally you are able to get this sort of a customization. I'm sure it will be there. Otherwise, those who are using Tally may need to customize it to get this information on an ongoing basis. For the purpose of auditing, the audit team would have to include this in its audit program, that when it is doing its vouching, doing its verification, they will ensure that the bills which they are vouched are following in any one of this category. And there's a testing of the controls and the system so that at the year end, when the information is given by the management, they should have no difficulty in accepting him for disclosure. Otherwise, it would take a long time to put them in the right buckets. Another important disclosure, which is generally not given, but is required to be given, is the unbilled dues. Unbilled revenues we know, which is in trade receivable, but now they have got a concept of unbilled dues, that is accrual and provision. As the word very clearly indicates, accrual take place when the services are rendered. So the audit team has to ensure the amount which is accrual is scientifically decided, and there is no, or rather, the estimating errors are minimized. Generally, at the year end, for the purpose of true and fair, some of the vendors or service providers like transporters, couriers, logistics, their bills don't come in timely manner. These expenditures are accrued. So the audit team has to ensure that the accrual process is scientific. Otherwise, it may impact under provision of an expenditure and it will affect the profitability. If it is material, it may affect true and fair. So these precautions one may have to take while doing the audit. The other classification which is there is MSMED. What is MSMED? Yeah, we have a small link on that. The classification of enterprises, the Ministry of Classification of Enterprise, and enterprise shall be classified as micro, small, and medium enterprise on the basis of the following criteria. Micro enterprise, where the investment in plant and machinery or equipment does not exceed 1 crore and the turnover does not exceed 5 crore. Small enterprise, where the investment in plant and machinery or equipment does not exceed 10 crores or the turnover does not exceed 50 crores. Medium enterprise, where the investment in plant and machinery or equipment does not exceed 50 crores and the turnover does not exceed 250 crores. So the audit team has to apprise themselves to ensure that the management correctly classifies these enterprises based on the criteria of their turnover or based on the criteria of their investment in plant and machinery. So this will have to be built in your audit program. The company would have to do a search with all the vendor masters to ensure this criteria is put in the vendor master so that the computer program correctly reads and classifies these vendors according to this criteria. Okay. MSME classification, we are all aware, because if the MSME has to be paid within 45 days, and this information, who's an MSC and how the company is going to get the data of the MSC has to be thought out very properly so that there is no misclassification and an MSME has paid within the due date. Otherwise, there are penal provisions. You have to pay interest, which is a non-allowable expenditure. Though all of us who are familiar doing tax audit, this is the disclosure in tax audit, and it's a disallowable expenditure. So the criteria for finding out who's an MSC becomes significant. And every company requires to file MSME1 annually. That form, data in that form will be possible and will be correct only if the company is scientifically or collects information as a process and time to time evaluates that these information which they have collected in the past are relevant and meets the criteria. Otherwise, they need to revisit them so that the corrective factors are introduced and the vendor master is updated information. What are MSME, small and medium-sized enterprise? Yes, as I mentioned, there's an FAQ. What are the specific enterprise as per notification? There's complete. So we have attached a link later on when we share our PPT. These links will be available to you so that you can apprise yourself. The date of acceptance becomes a very significant date. It is the date where form that 45 days will be calculated so that the dues within 45 days needs to be paid. Otherwise, you may attract penalty. So company may have to invest or may have to upgrade its software to ensure that they get this data in a timely way so that this disclosure at the year end can be made. There's also an implication on the law of limitation and its impact on the IBC. So the audit team may have to evaluate, and those who are doing IBC audit for a supplier who's bought this particular impact is very important, whether those dues have to be paid and when they have to be paid. Trade receivable, yes, again, a comprehensive disclosure as compared to what was the disclosure earlier. The earlier disclosure was very simplistic, more than 6 months, less than 6 months. Doubtful, provision to be made. Now they have itemized this. Again, going from the aging schedule is required to be provided in respect to trade receivable. If no new due date of payment is specified, the date of the transaction shall be considered for this purpose. Unbilled dues shall be disclosed separately by the company, and that those of us who are very familiar, AS7 construction contract speaks very elaborately on unbilled dues. Again, the disclosure has to be put in buckets, less than 6 months, 6 months to 1 year, 1 year to 2 years, 2 years to 3 years, and more than 3 years. The categorization which is required: undisputed trade receivable considered good, undisputed trade receivable considered doubtful, disputed trade receivable considered good, disputed trade receivable considered doubtful. As I wanted to mention in case of trade receivable also, what is disputed? The guidance note would have to come out to give a clarity, but going by its natural implication, disputed would be where there are legal cases. So we have to find out if there are legal cases, then what view has to be taken. So the senior audit manager would have to spend a lot of time with the in-house legal department to find out whether these receivables can be categorized as undisputed or whether they get categorized as disputed, and the reason for the same, and document. So this is going to become a very important part of our documentation, because if the firm is going to be subjected to peer review, this is one of the areas which the peer reviewer or the QRB reviewer would be having recourse to ensure a proper audit process was applied to collect appropriate evidence for the purpose of this disclosure. Uh, this disclosure for less than 6 months is done in case of NDS Division 2, where we do ECL provisioning. So those of you know the ECL expected credit loss. When the expected credit loss provisioning is done, which I'll be dealing in detail in the next session, this sort of a bucket has to be presented to the auditor by the management, and then based on this bucket, provisioning mechanism is worked out so that the provision is very scientific. It covers every debtor, including the one with whom business has been done for less than 30 days. So the provisioning under Division 2 therefore becomes very comprehensive, unlike what is in IGAAP, where we just do some sort of a blanket provision. In case of ECL, it is to be done on base of a very different criteria. And by the time the bucket comes to 2 or 3 years, almost 100% is provided. So that adds to the comprehensiveness of provision mechanism under India. So we will deal with that when we come. Another important aspect which we need to be considered is the operating cycle. Generally, for the company, the operating cycle is for a period of 12 months. Now, if you have a non-current trade receivable, then the bucket would be different. Outstanding for more than 1 year would go into the next bucket. Less than 1 year, the information won't get captured, because the operating cycle would be dealing differently in case of a non-current trade receivable. In case of a current trade receivable, less than 1 year would be captured, but less than 6 months data may not be captured. So the auditor has a lot of challenges to face when he is going to audit this particular aspect, because the correctness of thereof would again depend upon the logic which the management is going to put in the software. So during the course of your interim testing, one needs to test the control, one need to test the actual data, how these classifications are going to be done. And as I did not mention, but very obvious, what we are going to present for current year 21-22 would have previous year's figures. So 2021 would also be required to be put in this bucket. So one needs to start talking to the management to ensure that the current year's data is also captured, so that there's a time saving and it can get audited in the normal course. Another very significant disclosure which is required to be made is in case of CWIP and intangibles under development. Generally, this sort of inquiry provide aging schedule in respect of capital work in progress, intangible asset under development. If CWIP whose completion is overdue or has exceeded its cost, is generally covered under due diligence when we are appointed to do the due diligence on behalf of a client who wants to acquire another company, and we are evaluating the fixed asset. This becomes a very significant part of our inquiry, and now it is brought within the financial statement, so that you can understand the area and the expansion of the responsibility of the auditor. He has to do so much of additional testing with respect to CWIP, which otherwise one would only, oh, as long as there is no depreciation implication. CWIP, the way it is shown is fair enough, but now we need to subject this to a larger scrutiny because of the aging. The auditor's working papers will have to be very informative to ensure that the past data on CWIP is bought updated when he starts his current year's audit. And every year he needs to update. A lot of challenges the auditor would be facing because generally the company would not be giving this information very easily, especially in terms of whether the cost is getting exceeded as compared to the original plan. So first of all, one must have in your file or in your permanent audit file, what is the original plan for capitalization? What is the milestone completion from year to year? And which is the milestone presently the company has reached? Is it midway? It is upstream, almost coming very near to capitalization, or it is still in its initial stage. It becomes more challenging in case of intangibles under development. Intangible by their very nature, if you see as far as the risk of verifying PPE is concerned, intangible becomes very high on risk because an intangible is nothing but expenditure. In case of tangible assets, we can actually see it, we can view it. But in case of intangible, it is only an expenditure. And what actually gives it the shape of an asset, it's only documentary evidences. So it becomes very risky to see whether those intangible for whom the expenditure has been incurred, based on their aging, whether they are infractious and requires provisioning. So even at the CWIP stage, there would be impairment testing to be done. Is it showing that the asset, that CWIP is not going to get fructified into a tangible asset or being completed as an intangible asset? Then the auditor needs to discuss with the management and take a view whether provisioning is to be required or and the level of provisioning and how it has to be disclosed in the financial statement. In case of listed companies, of course, we'll be doing it division 2. It becomes a bit easier for the auditor because you have the support of an audit committee. You can take it up to the audit committee, and the audit committee on your behalf would be taking it up to the board. But in case of mid-sized company and small-sized company, these will become challenging because many times that information may not come forth very transparently or may come with a lot of conditions and lot of caveats. So the auditor needs to be very vigilant to ensure he takes the right decision. As I mentioned in the past, some of the companies for whom I used to fill the CMA form, one of the data which was required to be filled in the credit monitoring authorization form, arrangement form, was the health of the CWIP. So at that point in time, it used to get covered. So it's a very important thing, and it's good that it is brought within the financial statement. But again, the audit has to be very vigilant to ensure he is not caught on the wrong foot. And if the CWIP impact, the aging impact is quite large, the auditor may have to evaluate whether it has to be dealt in his audit report. If he feels that substantially the expenditure is becoming infractious and the materiality of it is such that it would be impacting the financial statement significantly, he may have to evaluate whether it should form part of his audit opinion. Another important disclosure now required in case of immovable property is the disclosure to be provided the details of immovable property whose title deeds are not held in the name of the company in the prescribed format. So this was already getting covered under Caro, as very correctly mentioned. And the other one, which is bought for the first time, is the Benami property. Any proceedings have been initiated or pending against the entity under the Benami Transactions Prohibition Act 1988, the corresponding disclosure shall be provided in the financial statement. Both are very significant, and we are dealing it with a separate side. In case of an immovable property, the company is required to provide details of the immovable property other than property where the company is the lessee, and the lease agreements are duly executed in the favor of the lessee, whose title deeds are not held in the name of the company in the prescribed format. If such immovable property is jointly held with others, details are required to be given to the extent of the company's share. If the company has revalued its property, plant and equipment, or intangible asset, it shall disclose as to whether the revaluation is based on the valuation of a registered valuer. So Preeti has given a very detailed relevant line item in the balance sheet, description of the item of the property, gross carrying value, title deed held in the name of, whether the title deed holder is a promoter, director, or relative of a promoter, director, or employee of the promoter or a director. Primarily related parties are getting covered. Property held since which date, and the reason for not being held in the name of the company. Again, a very difficult area to audit, though it appears very simple, but it is challenging. Challenging in case of now the auditor has to have recourse to all the title deeds. Maybe he may have to update his own permanent audit file with the details of all the properties. In case of large company, old companies may be difficult unless they have a repository where all the old title deed documents are available. Otherwise, it would be a challenge. A detailed inspection of the property would be required. As I mentioned, auditors may have to build up sufficient evidence, because if something comes up here, the regulator is going to haul up the auditor, because the auditor's files are the easiest place where information is supposed to be available as per any regulator in India. They feel the auditor is supposed to be holding information on behalf of everyone. So in the larger interest of your own firm, it is better to spend time in building up your file. In case of, as I mentioned, old companies, getting documents will be a challenging, preparing a repository. So it is good that you start dialoguing with your client who you feel is an old company and where document procurement would be a challenge. Start dialoguing with them. Try to find out alternate methods whereby you will be able to get the audit document which you require by the time you reach the year end. It would also be a challenge to find out from the company why a property is not held in the company's name, and how it's going to be transferred, getting details. If it is a disputed property, collating all the dispute will be again a very big challenge from the auditor's perspective. So it is not going to be very easy. And if you are going to discuss your fees, discuss also considering all this aspect, because you are going to be spending a lot of time and you will be putting a proper resource. It cannot be done only at an audit senior level. It will have to be done at the manager's level to find out all this reasoning so that this disclosure is completed. The next one is still going to be more difficult. Coming to the Benami property, this is also given in Caro, where the auditor needs to be commended. And therefore, it makes a lot of sense that both the information pertaining to property, plant, and equipment, which have been bought now within the ambit of Schedule 3, were outside it, were all only in the auditor's report. Now you can imagine how difficult it was for the auditor. He had to make a comment on an information which was with the company, but not in the financial statement. And I think the regulators realized the auditor's dilemma. And now they have asked the company by putting it in the revised Schedule 3 that now the company themselves have to take this responsibility to disclose this data. So it's not going to be one-sided. Now the auditor also has the management on whom he has to interact, with whom he has to interact. What is the information required? Where any proceedings have been initiated and pending against the company for holding any Benami property under the Benami Transaction Prohibition Act 1988 and the rules made thereunder, the company shall disclose the following: details of such property, including the year of acquisition, amounts thereof, details of the beneficiary. If the property is in the books, then reference to the item in the balance sheet. If the property is not in the books, then the fact shall be stated with reasons. Where there are proceedings against the company under this law as an abater of the transaction or as a transferor, then details shall be provided. Nature of proceedings, status of the same, and the company's view. So you can imagine the host of disclosure that is going to be required to be given, and the auditor is made party to it, that he has to ensure that he gets all this information. The information is complete, correct, appropriate, and correctly disclosed. It's going to be a challenge. The biggest challenge is that most of this information may not be easily available with the company. Now, details of beneficiaries. I doubt whether the company would very easily give us the details of beneficiary. The property, if it is not in the books, one has to find out why it is not in the books, from when it is not in the books, and if you be happening to audit those particular years when the property was in the Benami situation, but you were signing off, did it have any implication? Were you signing off something with ignorance, without knowing? What was the reliance on the letter of representation which you were taking for the management for those years? All these are very significant questions which the auditor will have to address. And as I mentioned, that he will have to engage legal counsels to guide him before he takes a proper decision. Though it appears very simplistic, it is not so. And we in the auditing fraternity will await what the guidance note is going to tell us in how to deal with this particular aspect. What is the Benami property? I think Preeti has a slide on that. The Benami Transaction Act. In this act, the word is used to define a transaction in which the real beneficiary is not the one in whose name the property is purchased. So you see how difficult it is. The one whose name appears is not the one who is going to enjoy the benefit of this property. As a result, the person whose name the property is purchased is just a ghost, a mask of the real beneficiary. So you can imagine the type of significance that this particular inquiry is going to have and how the auditor is going to deal with. In case of large audit firms, they have large resources they can have, but in case of mid-sized firm, it is going to be a difficult situation. So one has to be very prepared, and we hope the guidance note which the institute brings out will be able to provide us some recourse whereby we will be able to save or we'll be able to mitigate the risk emanating out of from such transactions. Extra risk for auditors: if the property is not in the books, then what is the solution? How will you find out a property is not in the books? So these are some things which we need to question, or we just rely what the management is telling us. whether we need to give adequate disclosures in our audit report, whether we need to give a disclaimer of opinion, or we have to give an unmodified opinion, modified opinion, how to deal, whether emphasis of matter. So many things which will be coming. The audit working paper file to be strongly built up. Collect all the details of pending cases which are available with the legal counsel. If you are lucky that the company is able to introduce you to the legal counsel and you are able to interact. In case of listed company, as I mentioned, easier because you can take the help of the audit committee who will be able to get you all these details. So it's a tough for non-listed company auditors because they have to deal with the local management and there's always a conflict of interest which takes place. Disclosure regarding revaluation. Yes, a very significant disclosure. I hope everybody is well familiar with the revised AS10. AS10 revised deals with revaluation in a very comprehensive way, the way Ind AS accounting standard requires that to be dealt with. Yes, we have a small write-up on that. Revaluation model, after recognition as an asset, an item of property, plant and equipment whose fair value can be measured reliably should be carried at a revalued amount, being its fair value at the date of the revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment. Revaluation should be made with sufficient regularity to ensure that the carrying amount does not differ materially from that which would be determined using fair value at the balance sheet date. So in the past, what we had observed that revaluation used to be a one-off item. It was not regular, but now the revised standard makes it compulsory that management at every reporting date should visit the revaluation to find out whether further revaluation needs to be done. And if further revaluation is warranted, one has to do it. And revaluation cannot be done for few assets. It has to be done for a class of assets. So there cannot be cherry picking. You have to do revaluation with sufficient regularity and it has to be done for the entire class. Revaluation amount will substitute the historical cost. So now depreciation will be calculated on the revalued amount. And the most important, which many companies, many accountants and many auditors fail to reckon is that the revalued amount should not exceed the net realizable value. So every time you do a revaluation, go back to what it is net realizable value. If the revaluation is exceeding that, then one has to stop. So it's fair valuation done with regularity, but with caution. It has to be done on a year-to-year basis and needs to be revisited at every balance sheet date. Auditors should be careful and diligently audit the impact of revaluation and should build up sufficient appropriate audit evidence in his working paper file, because this is going to be a very regular thing going forward. And it says that if any change is more than 10% in aggregate, the net carrying value of each class of property, plant and equipment needs to be disclosed. Okay, who can do a revaluation? Revaluation, now it is very well defined. Revaluation can be done only by a registered value. Who is a registered valuer? Yes, as per Rule 2 of the company's registered valuer rule 2017, a registered valuer is a valuer registered with the Insolvency and Bankruptcy Board under Rule 7(6) for carrying out valuation of assets belonging to a class or classes of company. So now revaluation cannot be done by the in-house architect, in-house engineer, in-house maintenance. Oh, this person is very experienced, which used to happen in the past. Now it has to be necessarily done by an appropriate valuer who meets the criteria. There is a process for getting yourself registered if you want to be a registered valuer. There's a link, and Preeti has given a whole detail. There's an exam to be passed before you become a certified revaluer. So all these criteria needs to be fulfilled. So again, for the auditor, he needs to put this in its audit program, and he needs to dispose of whether the audit program has comprehensively covered all these aspects. Otherwise, he would not be doing justice to the audit of revaluation amount. Loans and advances to related party. This also was disclosed in some particular way in the CARO, and good that it has been brought now within the ambit of the financial statement. Following disclosure shall be made where loans and advances in the nature of loans are granted to promoters, directors, KMPs, related parties as defined under the Companies Act 2013, either severally, jointly, or with any other person. What is the type of disclosure? Whether it is repayable on demand, or is it without specifying any terms or period of repayment? So in the old CARO also we had a disclosure whether there was a stipulation for repayment or without stipulation, whether the loan was taken, advances were given, with stipulation, without stipulation. So some sort of disclosure which has come in. Yeah. Who are getting covered? What is the type of disclosure? Amount of loans or advances in the nature of loan outstanding and the percentage of that particular loan to the total loan. So it is going to cover promoters, directors, KMPs, and related party. So it's a good disclosure, good information for stakeholders who are going to evaluate the financial statement, who are the ones who are taking money from the company. Yeah, what is the percentage that they have taken, whether it is at demand, without stipulation. So it's an object-oriented disclosure, and I think it's quite healthy and required. It's from the regulator's point of view. It also becomes a very good monitoring mechanism for the regulator. Just wanted to bring 2 points to your attention. The definition of related party. All of us are very familiar with the word related party, but the definition of a related party under the Companies Act and under the accounting standard are different. In this instant, in the instant case, the definition has to adhere to the definition under the Companies Act 2013. Who is a related party with reference to a company? Is a director or his relative. Again, the definition of relative is very wide under the Companies Act. So one has to be very careful when you're covering this particular aspect. Key managerial person or his relative, a firm in which a director, manager, or his relative is a partner, a private company in which a director or a manager is a member or a director, public limited company in which a director or a manager is a director or holds along with his relative more than 2% of its paid up capital, any body corporate whose board of directors, managing director, or manager is accustomed to act in accordance with the advice, direction, or instruction of a director or a manager, any person on whose advice, direction, or instruction a director or a manager is accustomed to act. It also covers a holding company, subsidiary of a holding company, such other persons as may be prescribed. A relative with reference to any person means anyone who is related to any one of the above. Those of us who are also doing tax audit would be familiar that this sort of a disclosure of coverage was under 40A to B, payment made to specified person. Though it may not necessarily be, but primarily it's covering all that, who those particular SSEs who are mentioned there under specified person. Related party definition under AS 18 is different. It talks about ownership directly or indirectly of more than half of the voting power, controls the composition of the board in case of a company, or the composition of the corresponding governing body, and substantial interest in the voting power and the power to direct by statute or agreement the initial or operating policies of the enterprise. Significant influence, participation in the financial and operating policy decision of an enterprise, but not a control. So if you see, both the definitions are different, but there it is restricted only to the Companies Act. So again, from the auditor's perspective, one needs to build this up in your audit program. You may have to make a checklist to give it to your team, that when they are seeing that all these aspects are covered. There's also a very significant disclosure, the disclosure of a KMP. Who qualifies for a KMP? Now, those who are doing listed company audit, they would be familiar because the names of the KMP are disclosed in the related party transaction. KMPs are also required to sign the balance sheet and the financial statement. But it is nonetheless, it's important to know the definition of a key managerial person under the Companies Act. As per section 251, key managerial person in relation to a company means the chief executive officer, managing director or the manager, company secretary, whole-time director, chief financial auditor, or such other officer as may be prescribed. So all these would be covered. They have to be built in your checklist when you are going to be vouching loans and advances to a related party. So a proper sign-off, a proper evidence will be required. In case of weak evidence, there should be an audit point to be taken up for discussion with the board of directors or with the audit committee, as the case may be. But it is a significant audit query which may come up and has to be dealt with correctly. This, as I mentioned earlier, this disclosure is good from the stakeholders' point of view and from the regulator's point of view. Disclosures of financial ratios. Yes, once again, as I mentioned in the preamble to my discussion on the Schedule 3, that the stakeholders, investors wanted financial statement to give indication on the health of the company. And one of the tools which are available to any evaluator is financial ratios. So now financial ratios, which used to be forming part of the information section of an annual report, some of these ratios are going to be now part of your audited financial disclosures. And the ratios have been broadly categorized into balance sheet related ratio, turnover related ratio, and income statement related ratios. And we are familiar with most of them. And the other requirement is explanation shall be provided for any change in the ratio by more than 25% as compared to the preceding financial year. So the same ratios were also, some of them were also there in case when we were filling up our CMA form, when we were preparing or applying for loan on behalf of our clients in good old days. This used to be filled in. Now this has become part of the financial disclosure. Current ratio, debt equity ratio, debt service ratio. In case of ratio, the most important aspect, which from the audit perspective, is what constitutes the numerator, what constitutes the denominator. The rest is only arithmetic. Numerator divided by denominator and multiplying by 100 will give you the ratio. But what constitutes, and therefore everybody very expectantly looks forward to the guidance note, which will be providing guidance on how the numerator has to be computed from the financial statement that will be available. The same guidance note was given also in case of tax audit, where ratios had to be disclosed, and the institute gave us a very comprehensive guidelines how to constitute those ratios, and so far they have stood the test of time. Hopefully, such guidance would also be coming forward. The whole purpose is what does the company want to convey, or rather, what would get conveyed by way of this ratio would determine the type of information that the company would share. If the company feels that its health would be revealed, there will be no secrecy. So if I do some window dressing on the balance sheet, or if I do some window dressing on the income statement, these ratios would reveal those. So the information to come from the company will be little slow. One has to be very persuasive to ensure you get. But be very clear that you built up a perfect evidence file, so that tomorrow, if you're called up by any regulator, at least you will know the basis on which you calculated your numerator and the basis on which you have calculated it. What we look forward to is that the guidance note would say, yes, what the company should disclose what constitutes a numerator, and the company should disclose what constitutes the denominator. I think some of these debt service coverage ratios are also disclosed now in the financial statement, where borrowings are taking place, like when you have a NCD, a borrowings, that some of this criteria needs to be met. So they are disclosed. So there will be some sort of a uniformity which will be coming from that perspective. Yes, now we come to the second aspect. It's already 1.5 hours, 5:30. Presentation of Division 1, Property, Plant and Equipment. There's a change in the title. Current maturities of long-term debt, classification changes, security deposit to be shown under other non-current asset, total revenue, terminology changed, rounding off of the amounts in the financial statement is mandated, and Section 8 company are required to show revenue in under revenue from operation. Yes. The property, plant and equipment title change, state the changes on the face of the balance sheet. Under the old regime, we were using the word tangible asset. Now, in the new regime for 21-22, it will be property, plant and equipment and intangible asset. So the word tangible asset is gone. There will be no more disclosure on that particular item. Current maturities of long-term debt. Yes, current maturities of long-term debt means the amount of debt that is going to mature within coming 12 months. This is again rationalization of the disclosure. In the past, this disclosure was being made separately, but now they want us to be showing it under short-term borrowing, and it makes sense to show it under short-term borrowing. So it is only a rationalization. The disclosure was there in some form or the other, but was being shown under current liability. Security deposit, again, long-term omitted from loans and advances and now bought under other current asset. Again, it is a rationalization. The manner in which it has to be disclosed, maybe we will again, whether we have to have recourse to the accounting standard or whether the guidance note would give us further guidance on this matter. One has to wait and see, but it's a little simplistic disclosure. It's just changing from loans and advance to other non-current assets. Under the presumption that security deposits are going to be staying for a long time on the balance sheet, and primarily, if from our historical observation, security deposits are premises based, or they are deposits with some utilities which continue for a very long time, and therefore they are getting the disclosure has got rationalized. Again, this is a change in what total revenue. In the old regime, we were showing as total revenue. Now we have to show it as total income. So this is also to bring it in line with some rationalization. So maybe when the ratios or other disclosures of the income to earn by a particular entity is required, now it will be based on total income and not on total revenue, which was causing confusion. Rounding off, yes, Schedule 3 already required that a company shall round off figures in the financial statement. Previously, the rounding off was optional for the company, but now it has been made mandatory. They've also categorized how the rounding off has to be done. If the company is earning an income less than 100 crores, then the rounding off should be nearest to hundreds, thousands, lakhs, or millions, or decimals thereof. If it is 100 crores and above, to the nearest lakhs, millions, or crores, or decimal thereof. So again, a little more of rationalization was always there. Another point to be yes, Preeti, just keep that. Another point to be addressed, that once you exercise an option, then you cannot generally change. So if you say I want to show it in nearest lakhs, millions, or crores, then you cannot say I'll go back to 100,000 lakhs or millions or decimal. So one has to make the election once, and then it has to be consistent. Otherwise, every time the previous year's figures would have to. In case of Section 8 companies, as this is also a rationalization of the disclosure and a welcome suggestion also. Primarily, a Section 8 company is a not-for-profit making organization. They don't earn profit for the sake of distribution of dividend or for the sake of enjoying the benefits of it. They earn profit to further the objective of that Section 8 company, and primarily it is for the benefit of the society at large. So Section 8 companies, as part of their normal operations, are known to be collecting grants or donation. They receive grants, they receive donation, and very correctly so, because this grants and donation, if you compare to a normal operating or profit-making company, they become revenue from operation, and therefore they are to be classified as revenue from operation should include further classification as grants or donation. So they are operating activity for a non-profit organization. Another one which we will be dealing later on. Yes, Preeti has got a, yes, Preeti, just go back. Just go back to that. Section 8 company, yeah. So Preeti has got a, how, this is the way the disclosure will be made for a Section 8 company: revenue from operation, grants received, donation received, others, and total. So they will get itemized and the disclosure will get rationalized. So the reader of the financial statement would get the complete impact of the activity which has been pursued. Will also get an impact of the source from where the grants are coming and the nature, that either it's a grant or a donation. Yeah. Other requirements: control on the fund movement, relationship with stuck-off companies, compliance with approved scheme of arrangement, registration of charges, satisfaction of charges, details of cryptocurrencies, undisclosed income, corporate social responsibility. Control on the movements of fund. This is a new and a very important disclosure. This is an additional information which I think is been put in on the recommendation of the regulator. Yeah, just go. Disclosure of the circular movement of fund. And as you say, the primary objective is the regulator would like to find out ultimately the company has given the funds to whom, or the company has received the fund from whom. who's the ultimate beneficiary. Where a company has advanced or loaned or invested funds, either borrowed funds or its share capital or any other source or kind of fund to any other person, entity, including a foreign entity, intermediaries, with the understanding, whether recorded in writing or otherwise, that the intermediary shall directly or indirectly lend or invest in any other person or entity identified in any manner whatsoever by or on behalf of the company. So the ultimate beneficiary or provide any guarantee, security or the likes to or on behalf of the ultimate beneficiary. So ultimately, the funds can move anyhow, wherever it is going. The regulator would like to know ultimately who has benefited, and that particular disclosure needs to be given. And I'm sure all of you will appreciate again how difficult it is going to be for the attesting auditor. How he has to modify his audit program to now find out who is the ultimate beneficiary, through how many intermediaries it has passed, and to make his position a little more difficult, the agreement with those intermediaries may be recorded or not recorded. So one need not necessarily have recourse to what is in writing, whether recorded in writing or otherwise, whether it is directly or indirectly. So he has to be very, very careful in planning his testing of this area. And what are the disclosures required? Date and the amount of fund advance, loans invested in the intermediary with complete detail of each intermediary, date and amount of the fund further advanced, loan or invested by such intermediaries to others, other intermediaries, ultimate beneficiaries with complete detail of ultimate beneficiaries. So he has to follow the trail of the funds. Not going to be a very easy proposition. He has to put in proper level of resources who will be able to understand that rather than getting lost in the maze of transfers, he has to focus who is going to be the ultimate beneficiary. Date and the amount of guarantee, security or the like provided on behalf of the ultimate beneficiary. Declaration that relevant provision of FEMA 1992, Companies Act 2013 has been complied with for such transactions, and the transactions are not in violation of the Prevention of Money Laundering Act 2002. Same is applicable even in case when the company has received any fund from any person or entity, including a foreign entity. I think everybody is just going to wait for the guidance note from the institute. How much of investigation we need to done, whether we need to be doing a roaring inquiry, how much of reliance has to be placed on the management representation, how much of reliance has to be paid, what is available in the public domain, if at all it is available. All these guidance will be required because there are two particular acts also to be covered. FEMA 1992 and Prevention of Money Laundering Act 2002. Both in itself are very difficult. As far as FEMA is concerned, it has been administered by RBI. So one would not like to get caught up on the wrong side by RBI. But there are a lot of work to be done. And this particular aspect which needs to be audited will have to be audited by the right and experienced resource from the audit firm. It is not going to be a casual inquiry one makes in case of loans and advances given. It has to be very directional. You have to collect sufficient and appropriate evidence so that when any regulator inquires about it, you will not be found wanting, your papers will not be found to be insufficient. As I mentioned, in case of listed companies, generally they have to be reviewed by a second partner, so that benefit one is available. But in case of non-listed entity, the signing partner has to rely on his judgment, has to rely on the judgment of his manager and on a senior. So it has to be a very coordinated audit which requires to be done. Use of borrowings from banks, financial institutions for specific purposes. Where the company has not used the borrowing from banks and financial institutions for the specific purpose for which the loan was taken at the balance sheet date, the company shall disclose the details of where they have been used. This too is not a very easy proposition to do. Question arises, at what point in time has the inquiry to be made? It's given here at the balance sheet date for which the loan was taken at the balance sheet date. If the auditor comes across the situation, a company has borrowed money, used it for some other purpose than intended throughout the year, but at the balance sheet date brought it back to disclose it has been used for its intended purpose, then what is the nature of inquiry to be done? What is the nature of disclosure to be done? How one has to deal with in the auditor's report, how one has to be dealing with it, whether special note to be given, how one has to deal with in the letter of representation. All these questions would arise, and we will, I think the audit committee will again look forward to the guidance note for clarification. The challenges tracking how funds were ultimately used. They'll require a good software support. If the software of the company is good enough, then audit trails can be maintained. Collating all details necessary for disclosure is also going to be a challenge. Responsibility of the company's management to prove utilization. The primary responsibility will be of the company's management. How much reliability can the auditor place on that? Or he needs to be doing 100% review because this is the first time disclosure. He has to get confidence that the company's software is able to properly track it. So all these are challenges which needs to be addressed, not going to be very difficult. It's going to be time consuming, and therefore the auditor needs to start his dialogue as early as possible to get the company into the habit of tracking this disclosure, data required for this disclosure. Disclosures when borrowing based on security. This is also an enhanced disclosure where the company has borrowings from the bank or financial institution on the basis of security of current assets. It shall disclose the following: whether quarterly returns or statement of current assets filed by the company with banks or financial institution are in agreement with the books of account. If not, summary of reconciliation and reasons of material disclosure, if any, to be adequately. Auditor's responsibility in this case is also very high. Precaution needs to be exercised. How you're going to verify. Company will have a deadline to be filing filing a certificate with a particular banker or the financial institution which they normally ask. Once the information is given by way of certificate, at the year end, if you find that the disclosure given in the certificate was not correct, the company will put pressure on you, or do not disclose something, otherwise it will contradict the certificate. You yourself will be hauled up. So one has to be very careful. One has to be processed because the company is very, very eager to file a certificate. Oh, the same certificate which was given last year, we are just changing the date. It has to be given by way of routine to the banker, to the financial institution. Please do it. Otherwise, there's a penalty. Our loan will not be there, and they will put all sorts of pressure on you. But be careful. And now it's given. The two guidelines are given very clearly. It has to be in agreement with the books of accounts. So when you are going to sign this quarterly return, whether quarterly returns filed by the company, generally it will be audited by somebody or certified by somebody. Whether part of the audit evidence, are you taking the trial balance as on the date when you are going to attest? Is it going to be part of your evidence? Is it going to be part of the company's evidence? You may find the quarterly return, but there would be no evidence of a trial balance attached. So it will be very difficult later on, after 1 year or 2 years, if somebody asks you, just prove that this was in the books of account. So when you are going to sign, or when this quarterly returns are brought to you, or they have been disclosed, information is disclosed based on the quarterly return, ensure that copies, or at least the screenshot or the ledger of the books of accounts are attached as part of that return, so that you don't have to be found wanting if you're called up to certify how you went about auditing that particular aspect. And the other difficult part, if not, whether quarterly returns are not available where it is an agreement with the books of account, then summary reconciliation and reason of material discrepancy, if any, to be adequately recorded. So again, in our working paper file, we need to be having reconciliation. And when you are again doing a reconciliation, ensure that you have the printout of that particular ledger, or you have downloaded it. If it is a large software like SAP, there is no risk because it will be in the repository, it will be on the server. But if your client is having a small software like Tally, where it can be modified, please ensure you have that particular printout on your record. You have the reconciliation on your record, so that it doesn't become embarrassing. This particular aspect, the client would try to underplay, saying that, oh, it is a routine certificate, routine return. Do not allow the client to overrule your thought process. Please understand the gravity of the situation and take appropriate audit action. Compliance with the number of layers of the company. Again, a new disclosure requirement where the company has not complied with the number of layers prescribed under clause 87 of section 2 of the Act, read with the company's restriction on number of layers rule 2017, the name and the sin of the companies beyond the specified layers and the relationship extent of the holding company of the company in such downstream company shall be disclosed. The particular reason why this disclosure is important, because there is an enactment, and again the regulator would like the auditor to certify that this particular notification is not flouted. Now, what is number of layers? The number of layers, the Ministry of Corporate Affairs notified the company's restriction on number of layers rules 2017 on September 20, 2017. The rule has been issued pursuant to section 287 of the Companies Act 2013, which provides the central government the power to cap the number of layers of subsidiary that the company may have. Okay, so again, this becomes very, very important from the audit perspective. One has to be very familiar with what the Act says, what are the restrictions which are there, and what is the definition of the subsidiary under the Act, why why there is a restriction which has come, and are there any exemption? Okay, just go down to the exemption. Yes, there are 4 exemptions to the layers. The following classes of companies are specially exempted from the restriction on the number of layers: a banking company, non-banking financial company, which is considered to be systematically important, an insurance company, and a government company. So for very, very good reasons, they all justify the exemption. The rule do not restrict Indian companies from acquiring a foreign company with more than 2 layers of subsidiary if such layers of subsidiary company exist in accordance with the law of the jurisdiction of the foreign company. Yes, makes sense. In this context, it must be noted that the rule apply to the body corporate, which includes companies incorporated outside India. Hence, the rule can be read to say that the company outside India cannot have more than 2 layers of subsidiary in India as well. So not more than two layers. So one has to be vigilant, especially when one is doing the audit of related party transaction. Include this aspect also in your audit program. For the purpose of computing the number of layers under the rule, one layer which consists of one or more wholly owned subsidiary does not need to be taken into account. So here Preeti has given an example. There's a holding company, layer 1, layer 2, and layer 1 and layer 2, B1, B2. So it's very clearly indicating whether there is any breach of the particular rule. This particular aspect will be given in the link, so one can see it at leisure. It will take otherwise a long time for me to explain. As explained in the above section, a layer consisting of a wholly owned subsidiary is not taken into account for the purpose of calculating. So the wholly owned subsidiary is marked in green, calculating the number of permissible layer. Although the language of the rule is slightly ambiguous, the language could be interpreted to mean that the exemption works vertically and not horizontally. Okay, so there's an example. I think later on you can have a look at it from the link which explains in detail. Dilip sir, can I take a small break to have a glass of water?
Yeah, sir. Sure, sir. You
Yeah.
need not next to ask, sir.
Yeah,
Yes, sir, please.
Yeah,
Please,
I'll just
please,
take a
sir,
small.
please.
Shyam,
Yeah, yeah,
in case you want to
we'll-
take over from here, you may please.
Yeah, we have a break for around 2-3 minutes. Yes, no problem. Everything is going on very well.
Today we are having 131 participants. Thank you,
Yes.
all of you.
This is the record number of participants we
Yes.
have today.
Right, it was one time it had gone to 134.
Oh,
I think 133 at 517.
yes.
What is the present members number?
190.
190.
Our target is 300 members by end of the year.
Yes, sir.
Shamsundar, now
Ji.
Churchgate Study Circle is treated as one of the premier study circles of WIRC.
Oh, great, great.
Yes. So all the credit goes to my team members and my members.
Alright, sir, that goes without saying, sir. Full
Yes.
credit. No doubt.
Yes. Yeah. Are you taking over?
No, I think because as you said, it's only 2 to 3 minutes. I think everyone needs small
Yes,
break.
yes, naturally.
Hello. 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 Hello.
even I say Preeti has taken a lot of pains, lot
Yes.
of these things. She has prepared a very nice presentation, very
Yes.
extensive.
Yes.
Yes. And not only that, line item, but link to the definition and detail, all those things. Really.
I think,
Kudos
sir,
to-
hyperlinks are very essential whenever we present all these things.
Yes,
It
yes.
gives in a click of a button, you can go to this information or to the other
Yes, yes.
information, which otherwise we used to move the slides, sir. Or we used to say that we'll come back to you later.
Thank you, Dilip sir.
Yes, frankly, persons like Preeti are the backbone of any organization.
Yes, 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 sir. Yes, sir.
Really.
Yes, sir.
We are the face of the organization, but they are वो बोलते हैं ना नींव है अपना सबका.
Correct, 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 correct.
And every organization has such person.
Yeah,
Then it
correct,
survives.
correct, correct. Okay, Shyam, you're taking, go ahead.
No, I think he said, this continue. Once you
Ah.
complete, I'll take it because this he has given break for everyone.
Acha, okay. So just let us know, sir, when to commence.
Now, allow you take your own time. You decide when you want to start.
Yeah, I'm almost okay, sir.
I
Okay.
think, Edwin, 2 more minutes you can wait.
Okay.
Okay.
You generally have 2 webinars in a month.
Yes, we have 2 webinars.
Okay, sir. Okay.
And on the relevant topic, which is of relevant for that month. That way. See,
That's
next
correct,
month
sir.
we'll have a seminar on TDS, and there is this thing now accounting standard for non-corporate assessee also.
Yes, sir.
Entities, non-corporate
And
assessee
non-corporate entities.
entities also.
Yes, sir.
That we'll have to this thing. See, that's why we are spending a lot of money on Zoom, Zoom platform, because they have either capacity for 100 members and next lab is for 500 members.
Oh, there's a wide gap between.
Wide gap, and now we are spending a lot of money. That's why I want to increase my membership.
Okay, sir.
I think per month we are spending 16,000 Parag, around 16,000 rupees for
Yes,
this.
sir.
Yeah, yes, sir.
But is there any jurisdictional restriction from the institute?
No, jurisdiction, this thing I'm not getting you what you're saying.
No, sir. Since you have mentioned this as a Churchgate CP study circle, is it related to certain boundaries or something?
No, that means what? That we have to hold our meeting in that area only.
Okay.
Physical meeting. See, I cannot have physical meeting of Churchgate Study Circle in Thane.
Oh, okay.
Yes.
Oh.
Now this is
So
another thing.
you can draw members from any place. It has no relation to jurisdiction.
No. Yes, but the meeting is to be held in our vicinity.
Okay,
That's
sir.
why we have all our meetings in at St. Xavier's College.
Okay, sir.
There are so many detail of these things, so many instructions by CP Directorate. So we have to abide by all rules and regulations.
Okay, sir.
Okay, sir.
Yes.
I think, can we start, sir? I think
Yes, please. My pleasure. Please go ahead.
Okay. The next disclosure is disclosure in case of a company is where it is declared as a willful defaulter. Another very significant disclosure, and also a disclosure which the auditor may find it difficult to handle to get a complete view of before he forms his opinion. He has to rely primarily on the company's management to share the data. Where a company is declared willful defaulter by a bank or a financial institution or other lender, following detail shall be given. Date of declaration as a willful defaulter and details of default, amount and the nature. Who is a willful defaulter? Willful defaulter here means a person or an issuer who or which is categorized as a willful defaulter by any bank or financial institution as defined under the Act or the consortium thereof, in accordance with the guidelines on willful defaulters issued by the Reserve Bank of India. Now, in this case, two questions which comes in front of an auditor. How would he find, or from which public domain information would he find whether A, B, or C organization has been declared as a willful defaulter? So one thought which came to my mind was whether RBI has a repository. We checked up with the RBI website, the RBI does not have. But when we checked on the bank's website, yes, we found that the bank has a website where the list of willful defaulters are posted. So it becomes a public domain information. So if information is a public domain information and the auditor, while auditing, unfortunately misses to have recourse to this information and forms a wrong opinion, he can be guilty of negligence. So auditing community has to be very careful these days because most of the information is available in some website, some domain, somewhere or the other. So it will be very difficult for him to say that I was not aware and therefore I relied only on what the management told me and I took a representation on to that extent. That would not be a very smart move on the part of the auditor, and it would not be a very acceptable defense as far as the regulator is concerned. Did you just go to that? Willful default. So who is a willful defaulter is also been defined. I think there is a master circular. RBI has come out with a master circular where the willful defaulter has been defined, and one has to take recourse to the. I think she's just collating that information.
बेसिकली क्या है मालूम है हम लोग जो शेड्यूल 6 का जो
हाँ hello somebody said something. Okay, can you just go to the bank's website? So we have had recourse to the website of Bank of Baroda to see how this disclosure on the website of Bank of Baroda appears. There's some problem with opening that link. So the Bank of Baroda website very clearly has a list of what is a willful, who is posted as a willful defaulter. Yeah,
I think
okay.
Preeti is taking long time. I think you can go. Yeah. Otherwise, you may get stuck.
Yeah. No, I think she's got stuck. Just go quickly. Yeah. Just go out and just 2 minutes. Sorry, please. I think that her laptop has got hanged. We'll just tell her to log out and log in again. Just see, no? But can you put the other one, other slide? No, I think Shyam, she's having some issue with the laptop. I think that it has got hanged. Shyam?
It generally takes few minutes to.
Yes, hello, Edwin, we will wait because it's worth waiting for. What
Thank
the
you,
details
sir.
he has prepared
Yeah,
is
yeah,
worth
thank you.
waiting for.
Thank you, sir.
Yes,
So,
yes.
so far, how was clear, sir?
Array, amazing, yeah, really. It was beyond my expectation, I tell you, Edwin.
Thank you,
Really,
sir.
really.
Thank you,
I'm
sir.
so happy, yeah.
Thank you very much, sir.
Happy. Yes.
No, I try to give the background of, generally people are little bogged down with many details to be given in the financial statement. So I thought I'll build the right context
Yes.
that now giving these details are becoming more and more required by the regulator, by the shareholders, stakeholders, by the company. So that context I just wanted to give.
Yes, actually, we are getting many message chat box also. They are all the participants are also loving it.
Oh, thank you so
Yes.
much.
Great.
Thank you so much.
Great, great.
Thank you so much.
And it was so simple. It is, I mean, your explanation was in a simple manner and differentiate between the two different act definitions also. So really, it's really very good. I don't have words to speak.
Thank you. Thank you.
See, not only that, you're not explaining the line item, but with link, you are giving us definition of it and more explanation.
Correct.
That is easier for us.
Yeah, and
Just
also
like you explain in detail what is MSME, what is Benami property, related party.
Yes, sir.
So,
And also giving you the audit aspects of it.
Exactly.
What auditor would be encountering the difficulties when he comes to that.
And that is with practical guidance also. Where to look, what to look.
Yeah, correct, sir.
Yes.
Correct.
So meanwhile, can we ask you some question?
Yes, sir. Yes, sir.
Yeah. Jigar, please ask the question so that.
Yeah, we can use that time.
Yes, sure, sure. Yeah. The first question is, how does any lapse in disclosure as per Schedule 3 affect true and fair opinion of the auditor?
Okay, there are two things. True and fair aspect also deals with the regulatory disclosure. So if like Schedule 3 is under the Indian Companies Act 2013 format. So any format which is not met completely, that itself is an aberration, and the auditor has to bring to the attention of the reader that this particular format followed by the company for presenting its financial statement, it's not complete. It's not complete. It is not as per the framework. So that is the first disclosure he needs to give. Okay, so the error, yes. So they say error. Yes. Yeah. So when there is a, yeah, I'll just complete. Yeah. So when there is an error in the financial statement, that error is on two counts. One is there is an error in disclosure, correct? And then there is an error in the content. For example, that if loans and advances have to be disclosed under loans and advances, they unfortunately got disclosed under investment. So there's an error in disclosure, correct? It's in the
I
wrong.
request TN, please.
I think there's an echo.
Mute.
I think
Yes, because TN is there. Shamsundar is there.
Yeah.
Keep it on mute. Thank you.
Yeah.
It's open now.
Okay. Yeah. We are back. Okay, but we can complete this question. If you want, we can just complete the question. Yeah. So there are two things. One is disclosure of the framework, and secondly, disclosure of the content.
I request because
if my investment, if an investment is of 1,000 crore, but disclosure is done only of 800 crores. So there's a there's an error in the content. Okay. Yeah. Next questions. Any other?
Yeah, Jigar, what is the finish it up with the questions?
Yeah.
Are the amendments applicable to financial year ending on 30th June 2021.
No, it's applicable from 1st April 2021. It's applicable from that particular day. So in fact, many of them have sent their clarification to the MC and to the institute to bring this out very clearly, because initially when the amendment came and the notification came, there was a little confusion. For example, I complete the audit of 2021 in 21-22. So if I'm going to issue my audit report for 2021 in 21-22, then whether these amendments would be applicable when I'm signing off that report. You understand? So these were some confusion, but now the clarification has come. No, it will be applicable for that particular financial year. Okay, that is commencing from financial year 21-22, and therefore the disclosures are required to be given accordingly and to be dealt with by the auditor when he signs his audit report in 22-23.
Thank you, sir.
Okay.
How would one define disputed dues of MSME and other than MSME? It is very subjective.
Correct. You're very correctly. In fact, in my presentation itself, I had mentioned that the word disputed is not defined. So one has to go by its common understanding. A disputed dues means what? I have rendered a service of a particular nature, of a particular type, as per the contract. That means as per the purchase order, whether it is for goods or services. The renderer of the services is an MSME. He feels that the services have been rendered. Generally, in a company as part of its process, if any goods or services is rendered, it is subject to a quality review and there is an acceptance. So if there is an acceptance for the goods delivered or the services rendered by a responsible individual within the company who's consuming that services, he signs off, yes, MSME A has rendered the services. The goods are of the quality that we want. It is of the number of quantity is also accept as per the purchase order. We are accepting this good and this invoice can be accounted. If that be the case, then there should be no dispute. But if somebody accepts the good saying it is subject to usage, I will accept now, but if somebody rejects it when he is actually using, then that much of goods will be rejected or that much of services will be rejected. Now this is open-ended acceptance. It is not very clear. It is not very pinpointedly saying that. It is depending upon the variable condition. If somebody is disputing the quality is bad, then I will say, okay, it is bad. If the market returns the goods, then I will say, okay, these goods are bad, therefore I will not take it. So that becomes an open-ended. It can give rise to dispute. Now, another important aspect, the due date, the appointed date. So once by the appointed date, if the company accepts, yes, the MSME has rendered the services as per the quality, and on the appointed date, I am signing off and I am booking this invoice. There is no communication from the company to the MSME disputing what he has given, then there cannot be any rise for dispute. Okay, that's point number one. Point number two, which has to be remembered, even if the purchase order says the MSME can be paid within 60 days, it cannot overrule the act. The act says the MSME has to be paid within 45 days. So you cannot make an amendment of the act to your purchase order. You cannot say, I'll bypass, right? It is as illogical as a board of directors passing a resolution saying, we do not want to accept this amendment made by MCA and we will pass it in the AGM. Can an AGM or a board of director bypass the law of the land? The answer is no. So it's very clear under the MSME Act that within 45 days, they have to be paid. They have to be paid. Otherwise, the disclosure is required to be given. Okay, and if the payment is not made or the dues are outstanding, then they have to be disclosed in the MSME 1 form, which is mandatory for every company to file annually. So your books will contradict what you're disclosing in the form. Those forms have to be signed off by a responsible person or more from the CFO or a director level, and the regulator can haul him up if the disclosure is at variance with what is in the books. I hope I've cleared the point.
Yes, sir, very much. Sir, our next question from our conveyor Manish Bhai.
Yeah.
In case of software development company, how to report an expenditure incurred of salaries and other expenditures, capital revenue, where software development is a continuous process?
Correct. So in case of software companies now, it's a well-established fact that when a software company who gets an order from say a customer A says comes and gives to Wipro, I want you to develop software, this particular type of a software. This is the type of a report. This is the type of output which is required. Once that is defined, the software company starts preparing something called like a bill of material. A bill of material is generally prepared in case of a manufacturing company. In case of a software company, they prepare a bill of material for writing their programs. So when they are preparing that, they will be deciding what is the type of in-house resources which will be deployed to write this software. So this is the salary cost, this many are, this is the milestone. So based on all those inputs, the particular expenditure which is directly related to the development of software will start getting capitalized by way of capture on the particular sheet, which will be called a worksheet, but now it is all in software. So they will be started getting captured and that particular thing will get built up. So it will become like a cost for rendering that particular service to the software. And that statement will get collated at the end of the year. What lies in that will be carried as a project CWIP. So although you'll have on one side, you'll have the regular cost, which will be salary, you'll have a credit coming through the project CWIP. So the cost relating to the salary cost on a milestone basis, which will be captured in that particular statement, will get credited through the P&L.
Yeah, thank you, sir. Shall I continue the questions or?
Yeah, you can continue the question. Yeah.
Okay. Yeah.
If somebody has something on willful, then that one part is left. I'll complete that quickly. Okay.
How to determine the recoverable value of capital work in progress when a impairment criteria is triggered?
Correct. Okay. What is the standard says very clearly that when a CWIP is there, when we are also determining what is the NRV. Now here we are going to do an NRV testing and then decide if the NRV is lower than what is in CWIP. Indirectly, an impairment is already crept in. So what the CWIP will be achieving after it is completed? That is the first estimation which the company needs to do. So if the CWIP is at 60% stage, I need to complete 40%. So what is the cost for completing 40%? Okay. And what will be the value after that 40% is completed? Okay. Then I need to proportion it. If I proportion it to the 60% and I find that NRV value after proportionating is much lower than what is the cost which is captured, then there would be a requirement for impairment. The cost is much more than the value which one would be getting on completion of that project.
Yeah, thank you, sir. Sir, there is a continuous question on the software development, which you answered just before this question.
Yeah.
The software developed for general purpose like GST, TDS, income tax service for public at large. for such company, there is no order. How to match the revenue against that expenditure?
No, first of all, I mean, the question would need to be completed. Would somebody develop a software without a market? So before I do any activity, before any entrepreneur, if he's an entrepreneur who's using his own money, using a borrowing from the bank, he would take all precaution to ensure all that he is doing has to have a market. There has to be potential customers. Otherwise, why would he undertake an activity? So if I am going to be an entrepreneur who wants to play in the software market, yes, I know I am going to develop a GST software. But if GST has not been enacted by the government, suppose this situation was 5 years ago. If GST was not enacted, I would go a little slow. I would go a little slow on that. Or even if I would have developed, that would be something like a CWIP sitting in my books, because I have not tested. I'm only doing a redevelopment. So it could be expenditure under product development. It would be a balance sheet item, which I would be taking it on my balance sheet till it gets commercial relevance. So one has to first find out, why would somebody undertake an activity if there is no potential market? Okay, so is it an R&D or is it a development? Now, just to explain to you, even if suppose a company is undertaking an R&D, there are many companies who are undertaking R&D in pharma. There are many companies who are undertaking in life science. In case of R&D, again, there is a methodology. There is a process which is there. What it's called gate. So as your R&D expenditure progress from gate 1 to gate 2. Gate 1 means at the initial stage, do you feel there's a market? Okay, you go to gate 2, the next milestone. Yes, at that gate, when you incur expenditure up to gate 2, this is a technical word, they call it gate 2, which is milestone. Again, you evaluate. Okay, is there a market? Is it something like a .com company? What happened to the .com company? Fly-by-night operators, they all ran away. Do you find .com companies? You don't find, because that evaluation was very poorly done. So you check, yes. So now the present situation to give you in COVID-19, all pharma companies are trying to find a vaccine. Okay, so if you are a pharma company who's doing R&D to find out a vaccine, you will again, there are traditionally supposed to be 5 gates. So gate number 1, yes, what you have come, evaluate with what is available in the public domain. Yes, people said those who have COVID at the initial stage get high temperature, high body pain. Will this gate 1 go towards mitigating that medical problem? No, it is not. It has to be stopped there. Okay, so
Okay,
this is way how you progress. So you will not do any activity without having a market in mind.
The next question is, will an independent director be treated as KMP under section 251 of Companies Act 2013?
Will be treated as MP means managing.
Key managerial person.
And no,
Treated as
key managerial person has to be defined, and a resolution has to be passed to that effect, that I am designating A as a key managerial person. I am designating B as a key. So key managerial person, generally, they don't come by implication. What you're trying to tell me is whether an independent director by implication can be considered as the key managerial person. Not specifically, but maybe under very, very abnormal circumstances, For example, if unfortunately the present key managerial person have resigned or have left the company or have expired, and the independent director by his action, okay, he is giving an impression to the regulator, is giving an impression to the world of large that I am functioning, though I'm independent, but I am functioning or deemed to be functioning like a key managerial person. then he is wearing the hat of a key manager person. And in such circumstances, he can be asked. But otherwise, no.
Thank you, sir. Next question is, would non-payment of dues constitute disputable dues?
Not necessarily, not necessarily. I may not pay. Now just take the case of COVID-19. Many companies are not paying, though the dues are not disputed. So one has to go from case to case. You cannot take a blanket opinion. Okay, is the company having cash flow problem? Is the company not being able to generate sufficient borrowings to pay? What is the type of difficulty the company is facing? So generally in this circumstances, from the audit perspective, it is better to get a balance confirmation, because you will not have the opportunity to do a subsequent event review. That, okay, on 31st March, I had outstanding payment to supplier of 100 crores. In June, when the audit came, out of that 100 crores, I paid 80. So although balance confirmation did not come, I know 80 were balance dues because they were paid. I can check with the bank statement, and 20 is the one on which I need to form an opinion. But in case of this particular situation in which we are, many companies are not being able to pay. So they don't necessarily constitute that date. But yes, when a company is not paying its dues, then there are other inquiries which an auditor needs to do other than trade payable. Whether the company going concern is getting affected, whether the company is having problem with cash generation, whether the company is going to go into other situation where it will not be able to service its obligation, then the auditor needs to put a different inquiry. His audit testing has to change. His audit perspective has to change from that point of view.
Thank you. Sir, one more question there. Payment need to be made within 45 days from the payment due date, else interest is payable to vendor. When the payment will be considered to be due?
Yeah, the payment will be considered to be due. The Act very clearly mentions from the acceptance date. There's an acceptance date where the services rendered by the MSCB is accepted by the company, and 45 days from there gets calculated. So if within that particular 45 days from that particular date is not paid, then penal interest becomes due.
Okay, thank you, sir. You can carry on. All the questions are done.
All questions are done.
Yeah.
Thank you. Thank you very much. Thank you. Yeah. Okay, Preeti, come back. So now we have come to the last segment, that is willful defaulter, no, Preeti? Willful, yeah, just okay, just put that. So we'll just take it to the website of Bank of Baroda, where you can see for the first time how Bank of Baroda is disclosing the willful defaulter. Yeah, just make it. So this is directly from the website of Bank of Baroda. They have posted a willful defaulters detail as on 31st March 2021, and the details are given. Who's the customer, registered address, balance, what has happened, yeah, complete detail. So this is available in the public domain. So from the audit perspective, the auditor cannot be ignorant that I was not aware that the particular supplier with whom the customer was dealing was a willful defaulter as far as the bank is concerned. Another important aspect, which is the auditor has to work in close coordination with the management of the company to get further information for him to take it forward, his investigation forward. So he needs to dialogue with the company's management, the board of director or the audit committee or the general manager finance, and make him realize the importance of getting the information, importance of him to get the data, because RBI would also be having a look at the financial statement where a willful defaulter's disclosure has not been made correctly. So RBI themselves have a large database, so they can cross-verify. Yeah, and all of you are aware now, as far as the MCA is concerned, company's balance sheet have to be uploaded to the XBRL. So everything is available in the public domain with the Ministry of Companies Affairs. Yeah, and RBI can have recourse. Now there is a lot of dialogue happening between the regulators. There's a lot of data sharing between the regulators. So it's not going to be very difficult for RBI to zero down on a company who has not correctly disclosed the willful defaulter's name and details. Yeah, so with this, Shyam, now you can disclose that audit report. Companies Audit and Auditors Rule 2014.
Yes. Good evening, members.
Yes. Good evening. Good evening.
I think as you are all been informed by Edwin with respect to the notification on the amendment to the Schedule 3. As a sequel to that, I think on the same day, the Ministry of Corporate came out with a rule which is known as Companies Audit and Auditors Rules 2014, that is on 24th.
Yeah, sorry to interrupt, sir. 1 sec. So can you just on your video so that?
Yeah.
Yeah. Thank you, sir. Sorry, sir.
Yeah. No. Yeah. Okay. As a sequel, as I mentioned to you, that host of amendments have been made for Division 1, Division 2, and Division 3. Of course, Edwin was able to cover good part of Division 1 today. And as a sequel, as I just mentioned to you, the auditor's report should also contain some reporting aspect of certain things. So they introduced around 4-5 paragraphs as a part of the reporting part, which will be for the financial year 21-22. When all these informations are being disclosed by the entity, even the auditor need to report on certain aspects. I think, can you, before that, I'll just bring out what is SA 700. Preeti, can you just display that? As everybody, every member of the profession is aware, this SA 700 was last revised on making it applicable from 1st April 2018, though it was planned for 2017, it could not happen. So from 2018, it was made applicable. If you go to the illustration, the institute has given a 5 illustration. The illustration 1 refers to all the listed company entities of standalone. Then illustration 2 refers to consolidated account of a listed entity. Illustration 3 refers to unlisted entity. And the 4th and 5th is related to non-corporate entities. Of course, for the listed entities, there is additional information which need to be mentioned with respect to, yes, Preeti, just go to the third illustration. So wherein they need to cite regarding the key audit matters, which is applicable primarily to listed entities. Now I'm going to the illustration 3, which is for an unlisted company. So just scroll down, I'll just tell you the format of the reporting has not been changed. They only added at particular place these 5 paragraphs. Now coming here, stop here. Now on the report on other legal and the regulatory requirement, I think we are mentioning, wait, slow. Preeti, just go back. I think the first part relates to me drawing a reference in an annexure regarding the reporting on the CARO 2016. Of course, next year we'll have the 2020 next year. And there are about 6 items which relates to what I sought for or what I obtained, my opinion with respect to books tallying to the books of account tallying, balance sheet, profit and loss account, cash flow do tally with the books of account. And also it mentions, just please go down, that the company has followed the relevant accounting standard. And also I do mention that the directors are qualified to act as a director under section 164(2). There is also requirement under IFC, whether it is effectively working under another annexure. And the one which introduced 2 years back is regarding reporting on 197/16 with respect to remuneration to managerial remuneration part. Then came this H. If you see the H, you can see that. Hold on. Okay. So where this rule 11, where this present auditor's report amendment has happened. In fact, it was introduced on 24th March, and based on the responses from the stakeholders, I think government Ministry of Corporate was forced to defer by 1 year. On the 4th of July, they deferred both Schedule 3 as well as this auditor's report. Otherwise, the members would have been duty bound to cast upon report on this matters which we discussed. Now, on the very first one of H, where we do mention regarding the existence of pending litigation regarding contingent liability, there is no change. Number 2, with respect to do we have any foreseeable loss if any company is into derivative transaction. And the third one was related to Investor Education and Protection Fund, where a company having completed 7 years, if there are any default, they need to pay. After these 5 paragraphs have been added. I think Preeti, now you take those colored one. Not this other one. Now, I have given one illustrative audit report. You can just go down. Yes, after the point number 3, now based on the GSR circular 206E, I need to now report on whether the management has represented that. You can read for yourself. Just to bring in nutshell, what Edwin has just mentioned in his earlier slide with respect to intermediaries, ultimate beneficiaries with respect to certain advances are loaned to or invested in certain companies. And the second part will go with respect to certain foreign parties or foreign entities with funding parties, so which again relates to ultimate beneficiaries. Here, auditor is cast upon to respond to this by taking management's representation. I think that is how that wording was set, whether the management has represented that. This language goes as under that, whether the auditor is satisfied about the methodology they followed with respect to the advances or anything, or loans or investment has been done within the parameter. These were there in A as well as in B. On the C, if you just go below, Preeti, just please go down. So now here auditor has been supposed to mention that what is the audit procedure he has followed. So based on such audit procedure auditor followed, he has to mention that he has considered reasonably and appropriate in the circumstance that nothing has come to his notice with respect to any misstatement, material misstatement, if any, with respect to the above A and B. Another duty which has been cast upon for the auditor to comply with in this additional duty obligation was that there has been quite many cases where dividend has been declared by the company and many have not followed section 123. I think 123 does, have you got that slide, Preeti, 123? Or I'll read it.
Shyam, read it. Shyam, I think you read that 123.
No. Just a moment, I need to check. I think you had that slide. Next slide you can take. Next to next. No, that is not there.
Just a second, sir.
That's section 129, 123. Yes, I can. Can you? Okay, the section 123 says before declaration of dividend, what it says is that no dividend shall be declared or paid by a company for any financial year, except it is out of the profits of that year or out of the profits of the earlier year, provided depreciation has been properly provided. There are about 6 clauses. One of the clauses also say that the amount of dividend, including interim dividend, shall be deposited in a scheduled bank in a separate bank account within 5 days after the date of declaration in an AGM. It also further says that non-compliance of this section 123 attracts section 73 and 74 for willful default on the part of the director for making payment of dividend. Can you go back to the front one, yellow one? Then comes to the last one, as Edwin just mentioned regarding the accounting trail with respect to the software being installed in any organization, whether they have the feature of recording audit trail facility, and the same has been operated throughout the year for all the transactions. So we need to report on these. These 4 paragraphs have been added, making effective from 1st April 21. So first time we'll be reporting for the March 22 accounts. That is all from my side. Thank you.
Yeah, thank you, Shyam. Just again to re-emphasize, as many are accustomed when they are issuing an audit report to change the date and the year. So now for 21-22, please ensure these 5 paragraphs are there. We are sharing this audit report as a link, correct? Okay. We are sharing this audit report as a link with our presentation. So everybody, at least from Churchgate Study Circle, nobody should be defaulting when they're issuing an audit report under the new regime.
And Edwin, needless to add this is for an unlisted company.
Yeah, correct. So yeah. It is not that it is applicable to a listed company, as correctly mentioned. It is applicable to everyone. So one needs to be seeing this before one issues the audit report. And just to summarize in our traditional way, what did we learn? We learned about disclosure, disclose promoter shareholding, even in case of shareholding less than 5%. So promoter shareholding, there is no limit. It has to be disclosed, irrespective of the percentage. In case of other disclosure for share capital, criteria was 5%. So in case of promoters disclosure, there is no criteria. One mandatorily has to disclose. Additional disclosure required for trade receivable, trade payable, PPE, loans and advances from related parties. So one needs to ensure that you modify your audit program to specifically and directionally address the issues which was dealt with respect to these particular items: trade receivable, trade payable, property, plant and equipment, loans and advances from related party. Disclosure of 11 financial ratios, as mentioned, be very careful what you're going to put as the numerator and what you're going to put as the denominator. So if there's a guidance note, hopefully by the end of the year, if it comes, make sure, like what we do in case of tax audit, we follow the definitions correctly and we compute the ratios correctly. Change in the terminologies, like change from tangible to PPE and from total revenue to total income. Yeah. So now this becomes very relevant when you are going to give disclosures required for tender, and disclosure required to be given to banks and custom authorities. The definition is very different. So when you say total income, it means different. When you say total revenue, it means different. So one has to take cognizance of this finer point. Change in the classification of security deposit and current maturities of long-term debt. rounding off, not optional, but mandatory. So one has to be again very well prepared. What we suggest that to get into the habit of rounding off, start recasting 2021 with this particular criteria. So by the time you come to 21-22, your previous year's figures will be correctly rounded off based on the criteria given. Proper classification of revenue for Section 8 company, we need to give specifically grants or donations received. As mentioned, yes, this is rationalization of the disclosure. So one needs to take cognizance of that. Disclosure of ultimate beneficiary in case of loans taken or given. As just now it was explained that this is going to form part of your audit report under SA 700. So this becomes a very key item for you to audit because it has to be mandatorily commented in your audit report. So it cannot be approached very casually. You please modify your audit program for the year and put this in your audit program and make your senior person responsible for it. Requirement to disclosure the application of fund if it is borrowed by a bank for specific purpose and not used for specific purpose. Again, as I mentioned, that reporting will have to be done at the balance sheet date, but nonetheless, you need to be vigilant to monitor how the company is using the borrowed fund. And if at all the company is calling upon you to issue a certificate to be given to the financial institution or the bank, be extra cautious. Do not allow casual opinion to prevail in your mind because the requirement has changed. It needs to tally with the books of accounts. Yeah, so it is very, very important. Ensure that the details of security given to the bank on which loan is based is in agreement with the books of accounts. That's also again very, very important. This disclosure is also there in the normal notes where a borrowing is there needs to be taken. So one needs to be very, very careful of how you're dealing with this. Disclosure in case company fails to comply with restrictions on layers of company. Yes, again, you need to be constantly in dialogue with the company secretary, if there is one in the company, or with the legal department. Generally, small, medium-sized company where appointment of a company secretary is not mandatory. They outsource the system, so be in touch with them that they understand and they'll be able to give you all the information which is required. Disclosure in case a company is declared willful defaulter, again, a very, very significant responsibility on the auditor because there are two regulators who are involved. There is RBI, there is the bank, there is a ROC. Okay, so Ministry of Company Affairs. So there are three regulators. If it's a listed company, you're going to have SEBI as well. So make sure you do not default in this. So again, put it up on your audit checklist. Need to take a proper sign off from your senior person that he has collected sufficient appropriate evidence in support of the disclosure given and why he has given. The information available in the bank's websites. So put somebody to keep on seeing those bank websites, download them as part of your evidence. Changes in the audit report, yes, dealt with very sufficiently by Shyam Sundar. So our audit report will be available to you. Please have a recourse to it when you're going to issue it. With that, I think I have completed the day one's proceedings, and I don't know whether there are any still further questions which are there. I'll be happy to take them.
Oh, yes, there are a few more questions after
Yeah, please.
that.
Yeah, please. Yeah.
are the amendments in the audit report also applicable to consolidated audit reports?
Yes, generally what comes in a standalone by definition should come in the consolidated audit report as well, because these are changes made by the regulator. Okay. And when the regulator brought about these changes, there was no specific mention that CFS is exempted. So if you just go by the natural expectation, it is expected that what is in the standalone will also find its relevance in the consolidated financial audit report.
And there is
So even the disclosure would be applicable to consolidated accounts?
Now there are some exempted disclosures which are there. So you have to have a recourse to what the institute has come out with the guidance note on what are some of the disclosures which are in the standalone. They need not be given to the consolidated financial statement. Yeah, just to mention academically, Dilip bhai, I mean, just for everybody, would like your attention also on the matter. In case of a standalone, we disclose provision for tax. Correct? Provision for tax is a very important disclosure. When it comes to consolidation, do you think it should be shown as provision for tax? Do you find a tax? Do you find a return for a CFS entity? CFS is not a tax paying entity, but still that disclosure has come in CFS. So today, worldwide, it's not here, worldwide. So worldwide, they are applying the mind how to disclose provision for tax, which is applicable to a standalone financial statement because it is a tax-paying entity, but in case of CFS, which is not a tax-paying entity, whether it has to be disclosed in some other pocket, and that's what has been deliberated by the research committee. So not all disclosures coming in standalone. The institute has come up with some exemption, like those quantitative disclosures. Those are not required to be disclosed.
Yeah, that previously that's there, but this new amendments, whether they have given any bifurcation?
No, not yet. Now we'll wait for the guidance note which will come from the institute.
Only for the Caro 2020, they made
Yeah,
it very
please,
specific.
yeah, you did it. Please close your video. That's what.
Hello.
Yeah, I just rang you up to.
Dilip bhai, you need to mute.
Keep your video off. You did it very.
Sorry, sir.
Yeah. Okay. Now, Shyam, what is it?
I think in the case of Caro 2020, they specifically said it does not apply to consolidated accounts.
Yeah,
because
Caro 2020 may not apply. Yes.
Because
correct.
I think in the 1 year, I think 2015 created a lot of problem. They were mentioning what to mention.
Yes,
Then they were forced to come out with it. By the time damage was already done. In 2016, they said yes, result. Maybe here, I think whoever is who asked for this question, looks like when I'm having more than one subsidiary or when I have a subsidiary, and if those companies have got certain things as willful, this one, foreign funding and beneficial, what is that? Intermediaries and all those to come. Probably we may have to say with respect to subsidiaries. As of now, it is too early. As of now, they have mentioned only for the standalone. Probably they need to come because we are already mentioning even for this ICFR or IFC reporting. We do say that with respect to my subsidiaries, these are my observations. So it is already been addressed. Quite possible if the subsidiaries do have these issues, maybe they will come out that you need to even consolidate those reports for in your standalone CFS audit.
Yeah. So only the thought process, the underline is very important.
Right.
At CFS level, console level,
correct.
will those what you're consolidating have relevance, or they become lesser in magnitude because CFS is at a very high, it is at a group level. What is going to be disclosed at an individual level when it comes to that apex level, will it lose its relevance? That is the underline. So the reader of the financial statement, if he feels that that particular information is very important, even at the consolidated level, then the auditor needs to take a view along with the management and with the directors and the board and take a view on the matter.
Yeah, Jigar.
Yeah. The next one, could you please explain the rationale of placing a restriction on a layer of companies?
Because what was happening, the layers of companies were being used by many entities to hide many of their transactions, form layers and layers and layers, and some transaction, some dubious activities were getting hidden. And then the companies, the regulator realized that forming a company as a layer was very easy and a good conduit available to any parent. And that was one of the rationales which they had in mind. But I am not sure whether they were able to achieve that particular rationale, whether it was beneficial and they were able to plug in. I really have my doubt. Like what happened in case of this Benami Act which came. They thought it'll plug black money, but I still have my doubt whether black money has left us or it is now today disguised in some other way. So that was the rationale which was there.
So last but not least, another question. It's sir, it is sir very nicely explained and thanks for the same.
Thank you very much. Thank you very much.
Yeah.
Yeah, I hope we did justice to the 3 hours.
Yes, yes. Hello, you have done more than that.
Thank you, sir.
Yes.
Thank you very much, sir.
Now I request Manish to propose a very hearty vote of thanks to all the three of them.
Thank you, Dilip bhai. I welcome everybody on behalf of Circuits City Study Circle, and thank you all of you, all the participants, all the members participating in very huge numbers, and it is really helping us and motivating us to organize more and more topics and on different on the different subjects. Uh, uh, Apart from this, I, on behalf of Circle City Study Circle, thankful to Edwin sir and Sham Sundar sir and their team for accepting our invitation and and sharing their knowledge on the topic of amendment in Schedule 3, which is very useful and very current topic and will be helpful to all the members for reporting in financial year 2021. I think at the end of this today's session, at least 50% of the doubts and more clarity has came out. And I'm sure that after the end of the second session, all will be well versed with the basic provisions of the whatever amendments have taken place in Schedule 3 of the Companies Act, and they will be able to carry out their professional work in a very professional manner. I also thankful on behalf of all the members to Edwin sir and their team for sharing their link on the audit report, for format of audit report, which definitely going to help all of us while framing, while writing their audit reports. And as Edwin sir has rightly said that at least members of Churchgate City Study Circle will not be in a problematic situation as far as reporting is concerned under Companies Act. So thank you once again on behalf of Churchgate City Study Circle. Thank you. Good evening. Good night.
Thank you. Thank you. Thank you. And
Thank you
see
so
you all
much.
on
Thank you
Friday.
so much.
Yeah.
Thank you very much. Thank you very much.
Thank you very much.
See you all again on 28th at 4
Yeah.
o'clock.
4 o'clock. Thank you, sir.
Thank
Okay.
you so much. Thank you
Thank
so
you.
much.
Okay, Preeti. See you.
See you.
Yeah.
Thank you.
Thank you.
Okay.
Yes,
Bye.
sir.
Bye, Sham.
Yeah, bye bye.
Yeah, thank you, sir. Thank you, sir.
Thank you.
Thank you.
Thank you.
Just a second.